everybody, today we are going to talk about Chapter 8, the expenditure cycle. What is the meaning of the expenditure cycle? The expenditure cycle is a set of business activities and related information processing operations associated with the purchase of and payment for goods and services. In the expenditure cycle, the primary external exchange of information is with suppliers. Within the organization, information about the need to purchase goods and materials flow to the expenditure cycle from the revenue and production cycles, inventory control, and department. Once the goods and materials arrive, notification of their receipt flows back to those sources from the expenditure cycle. Expenses data also flow from the expenditure cycle to the general ledger and reporting function for inclusion in the financial statements and various management reports. The primary objective of the expenditure cycle is to minimize the total cost of acquiring and maintaining inventory, supplies, and services. In order to be able to achieve the primary objective of the expenditure cycle, there are some decisions need to be made, such as what is the optimal level of inventory and supplies to carry? Which suppliers provide the best quality and service at the best prices? How can the organization consolidate purchases across units to obtain optimal prices? How can information technology be used to improve both the efficiency and the accuracy of the inbound logistic functions? How can the organization maintain sufficient cash to take the advantage of any discount suppliers offer? How can payment to vendors be managed to maximize cash flow? There are four basic activities performed in the expenditure cycle, which are ordering material supplies and service, receiving the material supplies and service, approving supplier invoices, and finally cash disbursement. Today we will talk about ordering material supplies and service. The first major business activity in the expenditure cycle is ordering inventory, supplies, or service, which involve two main steps. The first step is to identify what, when, and how much to purchase, and second step, choosing which supplier to purchase from. Inaccurate inventory records can create significant problems for organizations. Therefore, accountants and systems professionals need to understand best practice for managing inventory. We have three main approaches in order to control the inventory. The first one is economic order quantity. The second one is materials requirement planning, and finally just-in-time inventory. The traditional approach to managing inventory is to maintain sufficient stock so that production can continue without interruption, even if inventory use is greater than expected or if suppliers are late in making deliveries. This traditional approach is often called the economic order quantity approach because it's based on calculating an optimal order size to minimize the sum of ordering, carrying, and stock out cost. Ordering costs include all expenses associated with processing purchases transactions. Carrying costs are those associated with holding inventory. Stock out costs are those that result from inventory shortage, such as lost sales or production delay. The reorder point specifies when to order. Companies typically set the related point based on delivery time and desired level of safety stock to handle unexpected fluctuations on demand. The second approach is the material requirement planning, which seeks to reduce required inventory levels by improving the accuracy of forecasting techniques to better planning purchases to satisfy production needs. For example, the production planning department of a company using material requirement planning would use sales forecasts to prepare a detailed schedule specifying the quantities of each finished product to manufacture in a specified time period, such as the next 3 months. This schedule and the engineering specification for each product identify the quantities of raw materials parts and supplies needed in production and the point in time when they will needed. So, the material requirement planning system reduces uncertainty about when raw materials are needed and therefore enable companies to carry less inventory. The third approach in controlling the inventory is a just-in-time inventory system, which attempts to minimize, if not totally eliminate, finished goods inventory by purchasing and producing goods only in response to actual, rather than forecasted sales. Consequently, just-in-time systems are characterized by frequent delivery of small amounts of materials, parts, and supplies directly to the specific locations that require them when they are needed, rather than by infrequent bulk deliveries to a central receiving and storage facility. Therefore, a factory using just-in-time system will have a multiple receiving docks, each assigned to accept delivery of items needed to nearby work centers. Regardless of its sources, the need to purchase goods or supplies often results in the certain of a purchase requisition that identifies the requisitioner, specifies the delivery location and date needed, identifies the item number, description, quantity, and the price of each item requested, and makes a guess a supplier. The person approving the purchase requisition indicates the department number and the account number to which the purchase should be charged. What are the potential problems or threats that can face ordering goods? Inaccurate inventory records can result in stock out that lead to lost sales or to carrying excess inventory that increase costs. To reduce the risk of these problems, a perpetual inventory method should be used to ensure that information about inventory stocks is always current. However, data entry errors can result in accurate perpetual inventory records because even expert typists do make mistakes. Therefore, using information technology to eliminate the need for manual data entry can improve the accuracy of perpetual inventory records. The second threat is ordering unnecessary items. Another threat is purchasing items that are not currently needed. Accurate perpetual inventory records ensure that the validity of purchase requisitions that the inventory control system automatically generates. Supervisors need to review and approve purchase requisitions that individual employee initiate. A related problem is multiple purchases of the same item by different subunits of the same organization. As a result, the organization may be carrying a larger inventory than desired and may fail to take advantage of volume discounts that might be available. The solution of this problem is a centralized purchasing function, which can mitigate this threat. Once the need to purchase has been identified, the next step is to select a supplier. The buyer usually performs this task. In manufacturing companies, the purchasing function is closely related to the production cycle. Several factors should be considered when selecting suppliers. What are these factors? Are price, quality of the materials, dependability in making deliveries. It's also important to track and carefully evaluate supplier performance, including data on purchase prices, rework and scrap costs, supplier delivery performance. The purchasing function should be evaluated and reworded based on how well it minimizes total cost, not just the cost of purchasing the goods. Once a supplier has been selected for a product, their identity should become a part of the product inventory master file, so that the selection process doesn't have to be carried out for every purchase. A list of potential alternatives should be maintained for products that are seldom ordered. The selection process may be repeated every time. A purchase order is an electronic form that formally requests a supplier to sell and deliver specified products at a specific prices. It's also a promise to pay and become a contract once the supplier accepts it. The purchase order includes the name of the supplier and the purchasing agents, the order and requested delivery dates, the delivery location and shipping method, and the information about items ordered. Frequently, several purchase orders are generated to fill one purchase requisition, because different agents may be the preferred supplier for the various items requested. The quantity ordered may also differ from that requested to allow the purchaser to take advantage of quantity discounts. Many companies maintain special purchasing arrangements with important suppliers. A blanket purchase order or blanket order is a commitment to purchase specified items and design at specific prices from a particular supplier for a set time period. Most of them they are 1 year. Blanket purchase orders reduce suppliers' uncertainty about reliable sources of raw materials and help the supplier plan its capacity and operations more effectively. Vendor-managed inventory programs provide another means of reducing purchase and inventory costs. A vendor-managed inventory program essentially outsources much of inventory control and purchasing function. Suppliers are given access to sales and inventory data and are authorized to automatically replenish inventory when stocks fail to redundant reorder points. This arrangement cuts carrying costs by reducing the amount of the inventory on hand and lower processing costs by eliminating the need to generate and exchange formal purchase orders. What are the problems and threats that can face choosing a supplier? 5 threats to place orders with suppliers. The first one is to purchase items at inflated prices. The cost of purchasing component represents a substantial portion of the total cost of manufactured products. Therefore, companies strive to secure the best price for the items they purchase. Several procedures can help ensure the companies don't pay too much for specific products. Price lists for frequently purchased items should be stored in the computer and consulted with whether orders are made. The prices of many low-cost items can be easily determined from catalogs. Competitive written bids should be provided for high-cost and specialized products. Purchase orders should be reviewed to ensure that these processes have been followed. Budgets are also helpful in controlling purchasing expenses. In attempting to obtain the lowest possible prices, another threat is purchasing inferior quality products. So the second threat is purchasing goods of inferior quality. Substandard products can result in costly production delays. Moreover, the cost of scrap and rework often result in higher total production costs than if higher quality, more expensive materials had been initially purchased. One best practice is to establish a list of approved suppliers known to provide goods of acceptable quality. The third threat is unreliable performance by suppliers. One way to reduce the risk of problems within supplier dependability is to require suppliers to be certified as meeting international quality standards. The fourth threat is to purchase from unauthorized suppliers. Purchasing from unauthorized suppliers can result in numerous problems. Items may be of inferior quality or overpriced. The purchase may even cause legal problems. Different government agencies maintain lists of individuals and companies with whom it's illegal to transact business with. Payment to entities on such lists can result in substantial fines and sometimes deleted from the government. Consequently, all purchase orders should be reviewed to ensure that only approved suppliers are used. It is especially important to restrict access to the approved supplier list and to periodically review this list for any unauthorized changes. The last threat is kickbacks. Kickbacks are gifts from suppliers to purchasing agents for the purpose of influencing their choice of suppliers, which is the last threat. For the kickback to make economic sense, the supplier must find some way to recover the money spent on the prep. This usually is accomplished by inflating the price of subsequent purchases or by substituting goods or inferior quantity. Even if neither of these problems happen, kickback impairs the buyer objectivity. To prevent kickbacks, companies should prohibit purchasing agents from accepting any gifts from potential or existing suppliers. Kickbacks are difficult to prevent, so detective controls are also necessary. That's all for today. Thank you for listening.